Thank you, Leanne, and a very warm welcome to everybody to today's webinar. It's entitled Taxonomy Takeaways for Buildings, a Reprieve for Green Covered Bonds. And as many of you know, we've been, since 2012, working with Neil Day and his publication, The Covered Bond Report, in organizing an annual covered bond conference in Frankfurt. Sadly, last year we weren't able to do this, obviously because of the pandemic. But this year, we're pleased to be doing it again, albeit in a shorter, in a virtual format. And this year, we're very pleased to be working in partnership with a sister association, the Association of German Pfandbriefbanks, the VDP. And I'd like to thank Sasha Kulig, who will be closing the event, and his team for the great cooperation in setting this up today. Now, when I look back at a typical event agenda for this event over the years, normally we'd have a really very wide-ranging discussion focusing on the health of the covered bond market, the impact of the asset purchase programs, new supply versus redemptions, the regulatory issues impacting the covered bond market, new jurisdictions coming to the market, and of course, new structures. But this year, we're just going to home in on one aspect of the market, which is perhaps the most topical theme in the capital markets at the moment. And that is the continued growth of ESG, and in particular, the inclusion of environmental aspects in the covered bond market with a particular focus on the EU taxonomy. And although vanilla covered bond issuance decreased in 2020 compared to previous year, green covered bonds issuance continues to grow at a very fast pace. And in 2021, euro-denominated green covered bond issuances are expected to grow again by around 40%, and that'll reach around 33 billion. At ICMA, we've been supporting the evolution of the sustainable bond markets through the green bond principles, the social bond principles, and the sustainable bond guidelines. The GBP was first designed in 2014, and the GBP community now comprises around 400 institutions. It's a global grouping. There are issuers in there, intermediaries, investors, along with the related external reviewer community. We have Cicero on the panel later, NGOs and civil society. It's a very broad, a very inclusive group, and it's still growing. And as we've all seen, the green bond market has grown exponentially, and the pace of issuance this year so far is again at record levels, and we expect this to continue. And last year, as you probably know, it was the breakthrough year for the social bond market. So far, so good. But green and social bonds are only the beginning. If we're to make a meaningful contribution to meeting the ambitions of the Paris Agreement, we need to involve the hard-to-abate industries and find a mechanism for the bond markets to support the funding needed to transition their businesses to a more sustainable future. This transition discussion is critical, and as a result, we created last year the sustainability-linked bond principles, and these move away from the traditional use of proceeds concept and focus in a more holistic way on the issuing entity moving along a defined and measurable science-based climate transition pathway. This market has great potential and is starting to gather pace. It is certainly challenging to ensure that the targets are sufficiently ambitious and the financial penalties sufficiently meaningful. No doubt there'll be further guidance and clarification as it develops further, but it is an exciting development and it will make a difference. Of course, the covered bond market is part of the overall capital markets and arguably the highest credit quality segment. It's great to see how covered bond issuers have embraced ESG and built green bonds into their issuance programs. And this is also starting to develop in the sustainability-linked space. Now, I think we all know that as markets mature, voluntary standards are generally augmented with formal regulation. And this is currently exactly what is happening. The EU is globally advanced in this respect by building ESG considerations to much of the existing regulations through the EU taxonomy, the future EU green bond standard, and with new disclosure regulations. These include the SFDR and the recently announced Corporate Sustainability Reporting Directive, replacing the NFRD. And the regulations developing for the sector are complex. The data gathering exercise is going to be immense, and fitting them all together into a cohesive, usable, practical framework is an enormous challenge. This is a major focus for ICMA and our members, and one of the many ways in which we contribute to this is by being a member of the EU Platform on Sustainable Finance. The webinar today is going to look specifically at the provisions in the EU taxonomy relating to real estate, highly relevant to the cover pools. And we have absolutely expert panelists to do that. I'd really like to thank them all in advance, but particularly like to single out Sean Kidney from the Climate Bonds Initiative. This group really does fantastic work, and we're always pleased to cooperate with him and his team. And with that, I'd like to hand over to Neil Day, and I wish you all a very interesting webinar. Over to you, Neil.
Thank you, Martin, for the introduction, and thank you, ICMA, for again partnering with us on an event. We appreciate the cooperation and the organisation of the webinar and everything. Yes, I'm Neil Day. I'm Managing Editor of the Covered Bond Report. Some of you may have seen me at some of the conferences we've been to in previous years, but as Martin mentioned, it can't do at the moment. Also publishing a Sustainabonds publication focusing more on green and social, which is obviously, yes, very pertinent to today's discussion. I'll start off by asking my co-panelists if they can introduce themselves, if they've all got their mics and videos on now. We can start off with Krista.
Yes, good morning. Pleasure to be a part of this panel today on an important topic. I'm Krista Clapp from Cicero Shades of Green. I'm a co-founder of the subsidiary of Cicero Research Institute, and we're one of the leading external reviewers in the green bond market. One of the things that we do is use our methodology called Shades of Green to rate bonds light, medium, or dark green. And this method was built on a deep well of climate research together with Cicero Research Institute. And we feel that it encourages both the first steps along the green scale, as well as helps motivate deepening climate action at the dark green end of the scale. Looking forward to the panel discussion. Thanks.
Frank?
Yes, good morning. My name is Frank Damrow. I'm a Director of Sustainable Finance and Strategy at LBBW. LBBW is a frequent issuer in the green and social bond market. And with a total volume outstanding of green and social of about 6.5 billion, it's, as a relatively small bank on a global scale, it's one of the largest issuers of green and social or ESG bonds. We've been consistently developing and our methodologies. We pioneered the portfolio approach, which is the basis basically for our issuance capacity in several currencies in covered and uncovered format. And of course, we are looking at the latest developments around the taxonomy and how we can integrate those developments in our existing work.
Thanks. Sean?
Sean Kidney, CEO of the Climate Bonds Initiative. If you don't know who we are, you should have a look at our website. I work with governments around the world, Green Finance Task Force, the People's Bank of China originally, but over the last few years, European Commission expert groups from HLEG to TEG to Platform and so on, and work with all sorts of actors around the world, investors, banks like LBBW, and of course, I'm an admirer of the work of Cicero, who is number one, not one of the leading, but the leading issuer, second opinion provider globally. So I'm just excited about green bonds. I don't know why. I mean, they're meant to be boring, aren't they, bonds? But I find them exciting, especially when their proceeds go towards addressing the challenge of the millennia, climate change.
And Udo?
Yeah, hello everyone, good morning. Thank you to have me on the panel. And yeah, I'm taking care of ESG in Allianz Investment Management. That's the part of Allianz taking care of the 800 billion proprietary portfolio of Allianz. not to be mixed up with our asset manager, which is AGI and PIMCO. And yeah, what I'm doing is basically Allianz committed to net zero. We were the driving force behind the UN Net Zero Asset Owner Alliance. And my job now is to integrate really net zero strategies through all asset classes inside Allianz. Yeah, back to you, Neil.
Great, thank you all. So we came up with this idea partly of doing this webinar way back in November, December, not long after the taxonomy, the draft delegated act came out. Now, it was pretty apparent that there was a lot in the taxonomy that was not aligned with the way that green covered bonds had been produced up until that time, which I think used the top 15% kind of standards that the Climate Bonds Initiative and others had kind of deemed were appropriate kind of metrics for green bonds. So there was, I mean, I know they got 46,000 comments on the taxonomy overall. A lot of it quite negative. We did I don't know if anyone got a edition of the covered bond report at the turn of the year, where we had quite a dramatic feature on the threat that this was to covered bonds. Last week, the actual kind of text, the final text came out. Sean, what's the verdict at the end? Is it reprieve for green covered bonds, do you think?
Well, you know, I'm not sure about reprieve. Look, we're talking about legislation here. We're talking about a process of refining and drafting and a lot of complications in terms of arguments to different parties. So it's gone up and down. It's been communication by leak, unfortunately. Look, we need to look at the final text. That's what really counts here. In the final text, Climate Bonds Initiative, we are very happy. And I should say we're not the only one. At the European Mortgage Federation, European Covered Bond Council, to quote them, a significant step forward in development of a new market paradigm, which positions the financial services industry at the heart of efforts to scale up sustainable finance in the EU. Exactly right. This is a shopping list for the future. It clearly needs a level of ambition, but it is very pragmatic in recognizing that we don't shift the whole world to zero carbon buildings, which, by the way, we have to over time, but rather we drive transition. So it's a transition investment in the argot, in the language of the taxonomy. The thresholds will tighten over time. Every 3 years, there'll be a review. There will be means to try and get those tougher and tougher. In the meantime, it's part of a larger project, which is a common language for sustainable investments that will be used across the whole financial sector. Investors, corporations, and once the European Banking Authority gets its piece of regulation in place, banks, and expect it to be member states as well. So now, for the first time, when you look at someone's green or sustainable claims, you'll be able to compare them. Now, in the green bond sector, we've had that for a little while, although there are different rules and different, so this tool takes a bit of work, but across the disclosure of all actors in the financial sector, this is a revolution. You'll be able to compare the sustainability claims of an investor in Italy and an investor in Sweden in a way you haven't been able to before. So that's what the change is all about. It covers overall about 90% of the economy. In the green bond space, for green property bonds, we've got about 90 billion euros of green bonds outstanding in Europe so far. It's very important to build on that. The Commission has accepted the advice of various parties, from the technical expert group last March to industry players, banks around Europe, that the idea of the top 15% is a good idea to get the market going. And whilst there was an ambition to use the European's energy performance certificate system, that actually it's not fully fit for purpose. EPC-A and EPC-B and EPC-C and D mean different things in different countries because of the unfortunate differences in member state implementation of the idea of the scheme. So the Commission has said all EPC-A buildings anywhere in Europe or EPC 1, depending on the country again, will qualify. But the main measure is the top 15%, exactly as the technical expert group recommended in March of last year. If there is no EPC A or EPC categorization which meets that 15% or can be judged to do it. So look, we've got a bit of work to do to make this work, and that was the technical expert group's recommendation last March. Industry will need now to prove, and don't get me wrong, Climate Bonds Initiative, and I'm sure Cicero and many others will be working to support industry to make it easier to show that a building fits in the top 15% of existing stock to qualify. So that's the key measure. The other measures are slightly more complicated. So there is a building renovations measure, 30% improvement in primary energy demand. So that's a reasonable target, a relative level of ambition. There are a few do no significant harm measures you've got to address. And I'm sure Sasha later will talk about what those are and the challenges there. We need data points around the do no significant harm measures. Now, this is right along the idea you can't build a solar farm in a wetland. You can't build a railway line to a coal mine. It's low carbon transport, but you're carrying coal. Well, we've looked at similar sorts of things in housing that need to be addressed, but we do need to work on the data side there. And then for new buildings, it's a threshold which is based on the near zero energy building requirements that member states are introducing that become operational at the end of this year, the beginning of next year, progressively for public sector and commercial buildings. You've got to do 10% better than the threshold. This is not a particularly challenging goal. It's not quite what the TEG recommended, but for various reasons, they've decided in their wisdom that this is an achievable practical goal to allow a large amount of assets to be included, broadly consistent with the 15% level. Hey, let's see how we go. We have the option to review this on a 3-yearly basis. Transition investments, of which this is one, will be subject to review every 3 years. There is an understanding that a bond issued today will qualify for the tenor of its life. There's a few challenges here. When it comes down to Danish fund brief, which very tightly managed pool over the, say, 25-year tenor of a bond, we've got a bit of a difficulty working with this because an investor in 2050 wants to be confident the financial instrument they invested in meets the current criteria. If you meet the criteria today, they won't in 25 years or 30 years' time. So there's still some issues to be sorted out here. But generally, we're pretty happy for the buildings built before 31 December 2020 margin and the other two going forward. In the do no significant harm provisions for the first one, the acquisition and ownership of buildings, there is really only one do no significant harm measure, which is about addressing adaptation and resilience issues. Now, there's a bit of a challenge to work out the data points. There is a framework the Commission's provided for this. Our argument is that this needs to be addressed largely at a municipal and state level, but it can be addressed at a homeowner level or a building developer level or building a real estate trust level, I should say, go forward. But that's the only do no significant harm measure for the building's ownership and acquisition, which is where most of the green bonds in Europe are sourced from existing pools. So, look, it's pretty cool. Look at the context here. 110 countries have committed to 2050 net zero targets. Europe has committed to 2030 targets of 55% cuts in emissions, as in that the US and other countries are now committed to similar kind of targets. The needle is moving. We do need to address all of these issues going forward, and 40% of the emissions cuts we're going to get out of the energy sector come from the built environment. So clearly we have to act. It's not perfect, but it's a damn good start, and we can improve it with the help of folks like VDP and ICMA and ECBC in the next few years. So we'll tighten and tweak it further at a 3-year level to continue to improve this. There you go. Look, I'm happy. I think it's a great start.
Cool. Okay. Well, just to pick up on a couple of the points that you made there. I think the trick has been to balance the kind of ambition and realism in the taxonomy. Now, there have very publicly been some disagreements with some of the, I think, the members of the platform resigning from that in light of their argument that other parts of the taxonomy were not science-based, to use the term. And obviously, a lot of the complaints on buildings was that it was too ambitious and not very pragmatic. Krista, looking purely from the point of view of the science basis of it, and you know, are they strict enough to actually, for the green bonds that are being issued, to contribute to making a difference? What's your judgment on the way things came out? I mean, is it gone too far in terms of pragmatism?
Yeah, so I think Sean put it well, that it's you know, it's a really good start and it's a balance. But if I put myself in the shoes on the science side, I think we have to look at the shifting policy landscape that's underlying the taxonomy. So one of the things that we see in the final taxonomy is that you know, somewhat loosening of the criteria for the new buildings built beginning in this year and beyond. And this is an area from the science perspective where actually we should be tightening. So I hope to see that over time, because as we're building new buildings today, these are going to be lasting decades, maybe a century or longer. And then we've sort of locked in, if we're not planning for renovations along the way, that energy use. So this is where we can make a big difference to the climate over some decades, and where we need that criteria to be tight. How ambitious it is actually a little bit challenging to tell. Because of course it depends on this underlying the net zero regulations and how that's applied at the national level. So we're looking to see what happens over the course of the year. And I think what you know, a general feeling that we could say from, you know, a background of economics too, is that what we're doing with the taxonomy is layering in some regulations in the financial sector, which are not a full substitute for environmental regulations. So an easier way to go about this would be tightening the building codes. And that may be coming as the NZEB are implemented, but we don't know precisely how that's going to play out in different member states. So, so if we're looking at our methodology, for example, the shades of green, we use dark green to indicate Paris aligned. And where we see the taxonomy coming out is somewhere between light and dark green, depends on the context and the circumstances. On the building renovation, I can say that 30% is a target that's in line with scenarios that reach the Paris target. So I think that seems strong. Where I'd like to see a tightening is on these brand new builds.
Right. Okay. Now, Frank, as you mentioned, you know, LBW is a big issuer of ESG bonds in general, including green bonds, and you have buildings, as far as I'm aware, in your portfolio, in the eligible assets for your program. Are you able to do what you were able to do beforehand now the taxonomy is out? Is your issuance going to be taxonomy compliant, or is there a way in which this is actually hamstringing you in some way?
We had a look at this, of course, and since we finance not only projects in Europe, but also in the UK and the US, and on the renewable side in other countries. At the moment, we will use the climate bond standard because it's got a high investor acceptance. And but certainly what we can do on the real estate side is take on board the criteria of the taxonomy and build sub-portfolios as such. So it's at least easy to incorporate it, because there's been a lot of facilitation over the past 10 years. And, you know, I think so in that regard, the taxonomy is quite helpful. But essentially, I mean, banks finance the broader market as such. We finance, you know, certainly the real estate sector in different forms, from residential, of course, to commercial. So what we can do is show the relevant portfolios, because what we have done in our development work ever since 2017 was focus how we can be quite accurate and clean on the carbon emission side, basically. So that's one aspect we've been focusing on carbon in the context of the impact reporting. And so it's been a lot of facilitation, internal development, a number of processes and so forth, which is now required essentially by regulators anyway. But for I think the other ESG relevant factors that are now sort of part of the do no significant harm requirements. It's a little bit early for us because simply we don't have a lot of the information. And as Krista said, and we share that view also with Sean, of course, that we cannot drive environmental policy. I mean, we can, introduce transparency, no doubt, but obviously we need to be able to incorporate as banks a very broad spectrum of information that addresses various points of the taxonomy. So we've looked at it, yes, but for this year it's too early because it takes a lot within financial institutions to cover those points.
Okay, all right. Now, I mean, obviously, the taxonomy is relevant for all sides of the market. Investors, I mean, you have all sorts of kind of obligations coming in on reporting and the like. To what extent are you satisfied with the way the taxonomy has come out? I mean, does it make it easier or more difficult for you to know which kind of bonds you should be buying? And yeah, I mean, what's the implication of it for you? I mean, ultimately, this is meant to be stimulating kind of investment and support for financing green projects. Is it doing that? Oh, your microphone.
That's always a good idea to unmute. Yeah. Thanks. Now, we are positive on the taxonomy in general. As we see it as a starting point. It's really setting first time common standards. How it's really developing, we will see over time. I think it can really help to increase the supply side on green assets. Definitely, there is a huge demand on green assets in general. We see all these commitments now out. So everyone is looking to green the portfolios. And so we see a huge problem. There needs to be more supply on green assets. And I think the taxonomy is helping in that direction, definitely over time. The second point, it's really helpful where you need a binary decision, like is an asset qualifying for a green bond, yes or no? That's really helpful. That's a binary decision, that's helpful. And hopefully it will also start increasing in general the transparency on carbon emissions, on climate performance in the covered bond market. Because if people more and more look at taxonomy criteria, they will not only look at the green bond side, they will also look what's happening in the non-green bond side. We need transparency on all bonds. We want to understand the climate performance of all bonds in our portfolio, and we are miles away, and the taxonomy can only help. If it comes to portfolio steering, honestly, the binary decision, the way that the taxonomy is always binary, is not so helpful. We do it more on, so we really see as positive that now PCAF and GRESB joined forces with the CREM model. That's the way how we steer the portfolios with forward-looking pathways, because we want to know what is the requirement on our assets, especially on the real estate side, but more and more also on the covered bond and mortgage side. What is the requirement now? We need, it's very long term. We need to understand what are the requirements 2040. And that's still knowing how regulation works a little bit unclear. And that's the positive side when we were working with the CREM model. But as said, in general, we are quite positive on the taxonomy. It will help a lot.
All right. Okay. Now, we've come across it a couple of times already on the do no significant harm side of things. Now, there was a whole host of things, requirements that were listed in some of the draft versions that seemed quite burdensome. Frank, I mean, is that still an issue, or has that been resolved to some extent? And getting hold of the kind of data that you need to comply with that?
So on the data side, obviously we've done a lot of work in the early days. It was this, trying to establish top 15% benchmarks, but now of course we have switched the entire process to be EPC based. So yes, we've done many things to be much more accurate on the carbon side. And we, for example, also just as one innovation in the US, we can now also capture energy demand on a yearly basis. And so we're progressing certainly on that side, but obviously if it comes to other aspects of the taxonomy, like water, which is of course critically important, we have challenges, no doubt, like most other issues. And the question is, how can we really facilitate and resolve so that, because we're in the stage of capacity building and facilitation still. But equally, it's known, it's a broader issue for the entire market. So yeah, although we cannot show it at the moment, we will probably be able to do so if it's supported by the right environmental regulation, and that goes down to building regulation essentially.
All right. Okay.
Neil, could I come in on this point as well?
Sure.
Because I think Frank's raising some important issues that we're also seeing as, as a reviewer. We're in this practitioner space where we're beginning to work with some green bond issuers and some companies that are interested in preliminary alignment or reorientation towards the taxonomy. And this is exactly what we're seeing. The points that Frank is making is that there are a number that don't have the data needed in order to assess do no significant harm. And so we're in a position now where we need to pilot some ways of finding that balance as a reviewer to make sure we're being robust in saying we think it meets the do no significant harm criteria, but at the same time that balance with how much information do we really need. So in the review space, there's quite a bit of open interpretation, I would say. So it's a space to watch, I think, over the coming years, what comes out in the second opinions or company assessments, where we can sort of pilot some ways of implementing do no significant harm that provides that kind of balance that protects the environment, but at the same time still allows companies that are doing the right thing to be moving in this space. And it is a data issue, but it's also a capacity issue. And I think that's what I heard Frank saying too, is that, and Udo as well, is that there are institutions that may not have this internal capacity. It means a ripe space for more and more consultants. And I think we're just going to see a lot of variance in the detail and perhaps even in the quality. So it's a space that we're watching and perhaps investors want to watch going forward too. And we'd love some further guidance from the commission on this. I don't know if we can expect anything, but it would be nice. I should have started by saying that the do no significant harm approach is actually something we're really supportive of, and it's very compatible with the approach that we've developed too. It's a great way of building in the climate resiliency. At the same time, we're looking at energy efficiency in buildings. It's just the devil is in the details and how we implement it.
Right.
I'm going to say that there is more guidance coming. We will be working on that. But of course, it's something we need to do, in my view, in consultation of the industry. For example, of Cicero, get feedback about what works and so on. So there is guidance. This doesn't come into force till 1 January. In the second half of this year, we will be putting out some draft guidance and getting some feedback. So, Krista, I'm really hoping you'll give us some feedback. Separately to that, the Future of Sustainable Data Alliance that we're a member of, along with Bloomberg and Refurbishment and a bunch of others, is looking at how we can marshal existing data sources, improve the availability of data to be able to enrich the environment in line with the taxonomy to try and make things easier. Don't get me wrong, it's not there at the moment, but there are projects working on this to try and support this change. And it is clear that at the do no significant harm level in particular, important as it is, because we have neglected to look at these issues, which are actually material in the past, we have to uncover the information, particularly for banks. You know, if banks making a loan, a housing loan, there's only so much information they can collect in the limited amount of data. We can ask them to ask more questions. It is feasible, and there's got to be a little bit of give and take on that. But on the other side of it, we also need to ensure that municipalities, member states, and other parties are making that data available that can be used to it. A good example is the building labelling schemes. if the building labeling schemes become the norm and they have within them the data that we need, then a bank just needs to say, oh, EPCA or EPCB or whatever fits the 15%, bingo, my problems are solved. That makes Frank's job at LBBW a lot easier. And that's what we need to get to over the next period.
So, I think that guidance would be tremendously helpful, because in our, because we cover different markets, we had very significant different underlying information, from no information to very carbon specific information. And so again, exactly, if taxonomy requires that you incorporate certain criteria, you would best do it at exactly that level.
Okay, Udo, any particular aspects of this particularly concerning for you, or a pain for you?
Yeah, I would say the do no significant harm criteria are a pain. When investing in real estate direct, investing in funds, investing directly in mortgages, commercial and retail, and investing heavily in covered bonds. And it's just a nightmare. And we just do not see how we can really check all the DNSH criteria. And honestly, I think that should be reviewed completely. We need to be able to rely on national standards that correctly built buildings do no significant harm. This must be done by regulation and not by investors checking different criteria than actual regulation. Either regulation moves to the DNSH criteria or vice versa, that just on what kind of paint is used or what water taps are in a building, if you are a mortgage provider, that's out of your reach usually. And it's just, it will not save the climate.
All right. Okay, well, we'll leave that do no significant harm aside just for a minute, I think, as well. We've got a couple of questions coming in, and I'll keep an eye on them and maybe put the couple we've got at the moment to you shortly. Sean, now one thing obviously this meant to play into the taxonomy is the green bond standard. Now, while for example, the points on the kind of headline numbers, top 15% on that, that have been decided upon are maybe things that people would be happy to include in their framework. These do no significant harm and other elements might mean that it is harder for people to do everything that's need to meet the green bond standard. What's your outlook, I suppose, on whether we're going to see green bonds, particularly with buildings and green covered bonds, actually labelled as EU green bond standard bonds going forward? I mean, should we be quite cautious in our expectations on that front?
Well, there's a timing issue. When the green bond standard comes in, then it would be rather useful if the European Commission's own green bond program was consistent with the green bond standard. Yeah. And I think people in Brussels are aware of this issue. There are some challenges. The green bond standard is different to the taxonomy. It's a different piece of regulation. So the taxonomy is primarily guidance for disclosure by investors and the like on an annual basis. And there's a best efforts aspect to that, which is built into it, especially at the moment when data is becoming available in different areas. Because the green bond standard is likely to be a little bit more absolute, there is a question mark in terms of the drafting about the extent to which that best efforts gets codified in that. And picking up Udo's point, I personally am arguing for a strong approach to best efforts when it comes to doing significant harm, at least for an interim period of the first 3 years. We want to recognize the principle, but we want to recognize the challenges and not kill the market by making the challenges fight against the principle. But let's see where we go. And there'll be a draft, there'll be consultation processes. So I hope that Udo and Christo and others will put in their tuppence worth about how this works. The Resilience and Recovery Fund investment is a little bit challenging. As you know, a quarter of that's meant to be, or a third is meant to be funded by green bond issuance. It's challenging because the nature of the agreement signed of member states makes it hard for the Commission, virtually impossible for the Commission, to collect the data points around doing significant harm.
Yeah.
So you've already got a challenge here. What the way to address that challenge is the green bond standard, bridging the gap between what we have over here and the RRF agreement and where we would like to get to with an interim solution. So as you can see, I'm hoping that the green bond standard will give us the flexibility we need to be able to implement this over time without making it impossible given the current situations. And I'm saying publicly that it would be utterly lunatic to have a European, I'm used that word, European Commission green bond program that doesn't link across the taxonomy through an achievable framework, because otherwise, what's the point of the right hand doing something entirely different to what left hand's doing? So let's see if we can make this argument work. Let's see if we can get pragmatic and practical approach. The Commission, I think, is very open to these arguments, needs to hear them. And some of them have got to come from member states, which means I'm going to encourage Udo to speak to his government to make this argument as part of it too. You know, Europe is a funny kind of federation, right? The Commission does not make regulation for Europe on its own. It feeds regulatory ideas into a soup of bodies, the member states in particular, with the European Parliament playing a little bit of role on the side. So we need all of those bodies aligned to make something happen. And we've seen some problems in the drafts of the taxonomy because we weren't fully aligned. The green bond standard, I think we've got more chance of being fully aligned. So I'm hopeful, Neil, but you know, there's work to be done.
Sure. Okay, now I will invite more questions from the audience. We've got a few questions here. Now I'll read the first one, which is in relation to financing of public buildings. Including focus on school buildings. Usually they have more than 5,000 meters squared. From your understanding, is testing for airtightness, thermal integrity, and a global warming potential necessary to be taxonomy compliant? I think I've read something that says it is necessary. Does anyone read it carefully enough and remember that?
My understanding is it would be necessary.
Yeah.
But Frank's mentioned quite a few things in there, and Frank, it's great to have you on this, listening into this. I would need to check off all the different elements that Frank's raised to double check. But given the size of the buildings, then the proposal is that it would be necessary.
Yeah, I think so. Now the next.
So exactly. I mean, so basically. You know, so we see certain, particularly when you look at refurbishment, of course. I mean, you need a specialist to access to look at the building. And again, you know, if you have additional requirements, I mean, then there certainly the engineering specialists are equally involved in that, and their services are certainly required if you want to match those points that are relevant in the taxonomy.
Right. Okay.
Because we're not the experts in the technical assessments of these various criteria.
Okay, I'll just go on to the next. The next two questions really are, I think, in relation to pretty much the same kind of thing, which is about, you know, being able to make people afford green housing. First comment, a vast amount of residential building renovation is needed to meet the targets. The bulk of private householders are not going to do this voluntarily. The political will to force them may not be there. How can this gap be realistically bridged? And then how do we square off social exclusion? If we set standards so high, people can't afford to get mortgages. We have to remember the S, I guess, the social and not just the environmental. Any thoughts on that from any of you?
Yeah, I think both questions have, for me, the same answer. That's all linked to a social pricing system. We need, of course, for whatever refurbishment on private side or commercial side, a positive business case. Homeowners need for them in their local balance sheet a positive business case on doing whatever refurbishment, and that's really driven by price increases. And of course, a carbon price increase needs to be done in a social, solid way. That's for sure. So the answer to these questions goes hand in hand for me. Only carbon price can solve these problems. No other way I see.
Yes, I can build on what Udo was saying as well. So I have another hat that I wear as a lead author for the Intergovernmental Panel on Climate Change Assessment Report. And we spent a lot of time in those circles discussing the just transition. A just transition requires some of these very important considerations for who pays and the inequality that can come from that. But that's in relationship to environmental regulations or the carbon pricing that Udo is pointing out. When we talk about the taxonomy, this is a disclosure piece. It is not a environmental regulation. And that was one of the points I was trying to make earlier. It's not a substitute for environmental regulation. So we're not talking about who pays to meet the taxonomy. Rather, this is a voluntary disclosure tool to look at alignment. And where we need to talk about who is paying is when we actually get the tighter environmental regulations, which I would also love to see, as Udo pointed out.
Okay.
You know, let's be clear here. When we talk about energy efficiency, we are generally not talking about something, if it's done right, costs more. We're talking about something that saves money. We are talking about the return on investment is actually very good, including for people with low incomes. The question is who can afford to do it? And what we have to do clearly is to try and socialize the overall capital cost, to spread it across as many houses and homes as possible, to make sure that we can all get access to really energy efficiency buildings and reduce our damn energy bills. And while we're at it, reduce carbon. This is critical. There should be in properly designed schemes, no contradiction. The question is, how do we deliver this in our communities? How do we deliver this in our cities, in our homes? That's all it is. So it's not a financial imperative. It's not an argument that one would exclude the other. It's that we're not equitably delivering services and solutions everywhere. So I want to put the problem in the right place. The problem is not about going green and addressing social. The problem is ensuring that we do things at scale, at speed, across a broad enough part of society that we achieve the necessary changes that we have to do. And this is not actually a choice. This is actually utterly necessary for our society, for our future, for our kids. It's just a matter of getting on top of how to do it.
Yes. Now, I mean, I think I should mention, if I can put an answer. I mean, obviously, it's one of the things, the energy efficient mortgages initiative that the EMF ECBC, as Sean mentioned, has been working on. And I would suggest as a follow-up, anyone tune into one of their webinars as well. And I guess on that front as well, they'll be looking at, and this is, I suppose, goes a little bit into the economic incentives as well, is their kind of correlation study on the whether lower risk is related to energy efficiency and whether risk weights might be improved for green mortgages and green assets. So that's something that could play into that. Looking at the other couple of questions, I think there's one about about phasing in period for the EU Green Bond Standard. I think, Sean, you kind of addressed a bit that already. And then the NZ, yeah, I mean, this about the NZ, I think that's something, Krista, I mean, you talked before a bit that it's a bit of a mishmash, the standards there across countries, and not particularly, yeah, you can't necessarily compare.
Yeah, you know, the time frame for transition activity, if I look at the last question there, I mean, really, if we want to be Paris aligned, that is, you know, close to or at zero carbon emissions mid-century, and at the same time addressing resiliency to the impacts we're already seeing from climate change, from the emissions we've already put into the atmosphere, then assets that we're investing in now need to be close to that zero carbon space if their lifetime is going to extend over mid-century. So the transition activity, I mean, that can start now, but it needs to be tightening so that we hit that zero carbon space and resiliency planning sooner rather than later, and certainly by mid-century. So I, you know, Sean puts it well that you know, time is running a bit short, and that's why I was making the comments to be tighter on the new build construction requirements, because that's that's essentially locking in a long lifetime for buildings that are already here. Then we can do the renovations and the 30% reduction. That's in line with where we need to be mid-century. So it really depends on the specific activity, but you can generally say across all sectors, we need to be not emitting carbon and adapting to what we've already put into the atmosphere.
Right. Okay, Frank, you dropped out for a minute when there was, I think it was when I mentioned the Energy Efficient Mortgages Initiative, which I believe you probably had taken a look at. And I should also mention, I mean, there are other standards like, I mean, Sasha may mention it shortly, the green fan brief and things. To what extent do things like the ICMA, the Energy Efficient Mortgages Initiative, kind of play into this and stimulate the kind of green covered bond issuance that we might want to see?
I can't comment because in the past we've used the climate bond standard very strictly and get our heads around how we can be fairly accurate on that side, and that's also because, as I mentioned earlier, we cover portfolios. We do property finance also outside of the EU, so we have to address every market specifically so far. At the moment, we are perfectly fine with the catalog, the existing catalog. That's part of the taxonomy and the climate bond standard as such, because this is really what helped us a lot to develop our internal capacity, also with regards to broader ESG issues. And of course, we'll continue to, as news comes out or new developments come out, of course, and also in close cooperation with the SBO providers, we will slowly get there. But I guess so far we, with the taxonomy catalog and our EPC approach, I think we are for the moment we're fine and sort of meet best practice standards.
Okay, now we'll be wrapping up soon because we've got not much time left. I suppose it might be sensible from a practical perspective to address the final question that I've had, or one of the final questions that I've had there, and also Sean, to ask you something. I mean, one of the questions is how to fight lobbying. Now, I think that possibly is more with respect to nuclear and gas and some of the stuff that we've seen. And on gas, I know you're very passionate about that, and obviously amongst other things. But what if people do on the good side, I suppose, want to make sure this all works, make sure that we get better outcomes for the planet and in a way that we can actually handle them? What's the kind of next steps and the kind of input that people can give, and how should people be working towards a better kind of green bond market?
Well, I'll kick off. I'm sure all the others will have something to say on this question. We've learned something from the pandemic. We've learned something brutal, which is you listen to your scientists and you act fast. You don't mess around. And we can trace our changes back to the equivocating that we've had about taking action at different times instead of acting really rapidly. Speaking from a place at the moment where I am for another week in Australia, where there's been no COVID, where the clampdown was very, very fast, and also in Korea, and also in Taiwan, and also in other countries. So there's some lessons to be learned from the pandemic. And one of those lessons is listen to the science, and we need to listen to that as we think about this taxonomy, and we think about the risks we currently face from catastrophic climate change, which remains the trajectory we're on. Even though we're doing better than most in Europe, we have so much more to do. So that's the first thing I'd say, hammer home that message. Use the recovery to drive home the mantra, which has been the Commission's mantra, is Biden's mantra, and it has been the IMF's mantra, build back better. But let's do it properly, is the first point. And let's make sure that rhetoric is dominant in Europe. First point. Second point, we have a lot of arguments to have in Europe around buildings, around gas, around bioenergy, which is why those 5 experts left or suspended their membership of the platform because of bioenergy and forestry concerns. We have, in many areas, a policy that was developed for the year 2000, not the year 2020. The science has moved on. The IPCC 2018 report that Krista was involved in doing kind of is a bit of a freak out in terms of what we have to do. which is why we now have emissions reductions goals of 55% by 2030 in Europe and ratcheting up around the world. Our national energy policies, our forestry policies, our bioenergy policies, not to mention our gas policies, have not caught up with that yet.
Right.
And that's what we have to do now in the next 12 months. So for all of you, this is going to be an argument because we are having to deal with difficult changes to our energy policy, our building policy. It will be challenging for all of us. The main thing is to get in there and make sure your elected leaders, make sure your governments, including incoming governments in Germany, pivotal in this year's discussion about climate, listen to the science and act fast.
Okay, I think that's we'll have to finish there. Very good advice. Well, thank you all, my panelists, for a very interesting discussion, I think, and enlightening. And thank you to the audience for listening. Thank you to ICMA again for doing all the logistics and organising this and working with us, and also to the VDP for working on this and other things with us. And I'll hand over to Sasha Kulig, who's a member of the Board of Management of the VDP, to wrap things up for us. Thank you.
Thank you very much, Neil, and thank you, dear panelists, for the outstanding insights you have given in your debate. I'm convinced that today's guests from across the globe now have a much deeper understanding of sustainable finance and the EU's much observed exercise to define criteria and rules to promote it. My personal answer to the question Neil raised in the beginning would be, the EU taxonomy certainly is a big step forward, and perhaps may become a game changer in the climate fight now that we can see its final shape, at least for the first two environmental goals. With its publication on Wednesday last week, the European Commission marks great advance on its Green Deal and Next Generation Europe agenda. Yet, does the taxonomy really mark the beginning of an era of financial greening? Is it the proper means to the desired end, or is it rather red tape that will inhibit the dynamics we are already observing in the markets? Though we all just heard about the great potential of the EU taxonomy, there are still shortfalls and lots of follow-up work to be done yet. There's a thin line between preventing greenwashing and overly complex criteria that cannot be complied with. In many cases, it would be better to implement target standards directly in the real economy than to take a detour via the financial industry. This especially applies to some of the do no significant harm criteria for buildings. A big part of the problem with the taxonomy requirements continues to be data availability, and not only for banks, by the way. So here clearly more efforts are needed, and it was already mentioned in the panel. Further harmonization is needed as well. You just have to look at the differences in the energy performance certificates or the definitions of nearly zero energy buildings. So what does all this mean for green covered and unsecured green bonds? Does the taxonomy provoke greenwashing in the building industry? My answer is a clear no. Even though we have seen some important relaxations at the last moment, the standards embedded in the EU taxonomy are still ambitious and will pose a challenge for some time across the EU. And I'm afraid that especially some DNSH requirements make a 100% taxonomy proof difficult to achieve, at least for the time being. If the EU Green Bond standards to be enacted in early summer will require 100% taxonomy compliance, probably not many green bonds will be able to achieve this label, at least in the real estate segment and at least in the short term. The consequences that result for the issuance of green bonds will depend to a large extent on the behavior of investors. It is not unlikely that green investors will prefer green bonds that comply with future green bond standard, because this would allow them to prove taxonomy conformity of their portfolio holdings. However, given the challenges for issuers to comply with some DNSH criteria, it would be helpful if investors would focus on the technical screening criteria of the taxonomy only, at least for a transition period. You could call this a taxonomy alignment, so to speak. In addition, investors could increasingly rely on industry initiatives such as the VDP minimum standards for green fund reefer and the energy efficient mortgage label of the European Covered Bond Council. This would bridge the gap between the requirements of the taxonomy and the criteria that currently can realistically implement it in practice, thus ensuring that greening the system may continue and that the market is not stuck in a stop-and-go mode. Let me conclude. Even though the taxonomy criteria are the result of political compromise, we must not abandon scientific standards if we do want to succeed in greening this financial system with the help of the EU taxonomy. In any case, the taxonomy and the Delegated Act are a good start and do provide a basis to further elaborate on. Thank you to ICMA for co-hosting this event together with Germany's Pfandbrief banks. Special thank you to you, dear delegates, for taking your time and joining us for this important conversation.